Full House set to vote on a USMCA trade deal Thursday. It is expected to pass with bipartisan agreement and replace the 1994 NAFTA trade deal. Joining us with more to discuss this is Jeremy Bryan. He is a senior portfolio manager at Gradient Investments. And Jeremy, if it does pass, what kind of impact do we expect to see in the markets, or are we already there?
I think we're already there, to be completely honest with you. I think we're looking at an earnings season where we're probably going to have numbers coming down more than going up aggressively, especially based upon a trade deal. I think that's largely priced in. I don't think there's going to be a lot of impact, either negatively or positively as a result of it. I think the market's kind of digested it already. And unless we have a real negative transition, we're going to be pretty much on the same boat that we are right now.
So, Jeremy, seeing as you're focused on earnings here, especially going into 2020, and that they're maybe going to come down, there's been a lot of complaints and commentary around cash from companies going into things like buybacks and dividends rather than reinvesting in business growth. That hasn't been a problem for prices, though. Is it going to be a problem going into 2020?
No, I don't think, buybacks are just a component of the financial decision at the end of the day, right? You can reinvest in the companies, but I don't see that we've really suppressed CapEx in order to buy back more stock. I don't think that has a dramatic impact on what the company's decision is about their business opportunities going forward. If they use that cash for buybacks, that's fine. They may use that cash to buy other companies. That's the other choice they can make. What we like is we look for healthy companies that can make those choices, right? Because they're already investing in their business. They're doing exactly what they need to do. And then with regard to, hey, do we buy back or do we add acquisitive M&A and get scale that way? Those are decisions they can make, and we'll make those assessments whether those are good or bad at that point. But I really don't think buybacks are having a real hard impact on what's happening in the CapEx market. I think people are just much more cautious on overall sentiment with regard to trade uncertainty, these kinds of things, and what the economic growth looks like, and that's how they invest in their businesses.
Jared Blicker here. I want to ask you about currency headwinds or tailwinds as you want to look at it. The dollar had been creeping higher through a lot of the year, but kind of broke down recently, and it's really weakened with respect to the Mexican peso and also the Canadian dollar. So I'm just wondering how that plays out going forward. I mean, if the dollar continues to depreciate, how does that affect your analysis, and what if it reverses and strengthens?
Yeah, I mean, especially, this general trending of a stronger and stronger dollar up until recently has had a pretty negative impact on companies overall because, again, they have to convert their international back to U.S. dollars, which, lowers their earnings profiles. So even if we get a stabilized dollar, I don't think it has a dramatic amount of impact. And if we get an unfavorable dollar, maybe some of these international the revenue they generate from international actually gets a little bit of a tailwind. But, from our perspective, it's really difficult to make a call there. We prefer that, the dollar kind of just stay relatively static with where it's at to our extent, because then we can concentrate on what the actual business profiles look like. So for us, it's incredibly difficult to make those calls. So we try not to do it aggressively, but we are monitoring that impact and seeing what it's going to do to the earnings profile, especially for companies that have revenue outside the U.S.
What do you think about valuations going into 2020? I think, cash is almost free, right? And we talked about CapEx sort of simmering, but potentially growing if cash continues to be free. What do you think that does for valuations?
Yeah, we've seen a lot of that this year, right? I mean, if you look at the earnings profile from what we thought for calendar year 19 earnings and calendar year 20 earnings, they've largely come down over the course of the year. And then we've had an almost 30% run in the markets, right? So that's been a valuation change in saying that, we're okay with paying more because our rates have come down, these kinds of things. Money is, like you said, money is basically a zero cost at this point right now. Inflation's controlled, all that stuff. So we're willing to pay more for the market. Now, can that continue? Maybe, but we wouldn't bet on it. We think that 2020 is going to be much more of an earnings growth story, and that's what you'll get for return in the markets. And especially right now where we are from an elevated perspective, I don't know if we're going to stretch this significantly further from a valuation side. So 2020 can still work. We can still have an 8 to 10% earnings year, and that would give you an 8 to 10% market at current valuations. That's absolutely fine. What I would suggest is a much larger role in valuations going forward.
Jeremy Bryan, Senior Portfolio Manager at Gradient Investments. Thank you.
Thanks for having me.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.